Hey, welcome back. This is Mr. Market. Thank you so much for joining me. We're now into episode 15. Over the past week, the market had a pretty strong run. The inflation numbers came in lower than expected, which gave the market a lot of reason to think that maybe the Federal Reserve is getting pretty close to stopping its pace of interest rate increases. And based on that, and also the end of the quarter, we might have had a little bit of something called window dressing, which causes some of the fund managers to get rid of their losers and buy more of their winners. So at the end of the quarter, they can look a little bit better for their investors. We had a good week too. We were up $2,368, which put us up to $23,168, which is about 42% of our annual goal of $50,000 a year, or 20% a year. And as I promised, I'm going to give you an update on the pendulum algorithm, which had its 9-month anniversary this weekend. So we started this back in July of 2022. As you all remember, 2022 was a pretty rough year. In the first half, the market fell about 20%. And this was before I created an algorithm. I was down about 12%. So I was still beating the market, but I was trading mostly on instinct. And if there's one thing that I hate, it's that I hate losing money. Yes, I can beat the market, but if I'm losing money, I still don't consider that much of a win. There were things I knew I should be doing, but I wasn't, because it was so hard to go recognize losses and acknowledge that I was wrong. Basically, I was falling prey to all the primary weaknesses that you find in behavioral finance. The loss aversion, the prospect theory, endowment theory, all those things were hindering me from becoming a great trader because it stopped me from taking losses when I should be. And so that's when I created the pendulum algorithm, so I can get rid of a lot of these emotional biases that makes me into a weaker trader. And once I was able to get rid of that, I was able to formalize this into a decision-making process that basically helped me trade at my best. And what you see is the result of all that. So the objective was to create a strategy that would make money in rising and falling markets, a lot like the hedge fund that I co-managed from 2003 to 2013. That was a $50 million hedge fund that was very successful and actually made money during the 2008 financial crisis. Now for this fund, or rather this strategy, the goal is to go make 20% a year in rising or falling markets, and to do it with less risk than the stock market. And for the past 9 months, I think we've been able to achieve that. So now I present to you the performance and risk statistics for the pendulum algorithm. So over the past 9 months, it returned 28.23% compared to the S&P 500, making 9.9%, which is about 3 times above the rate of the market. Now regarding its risk levels, I think the true measure of risk is how much something loses money when the market falls. So over that same time period, the market fell 16.68%, whereas our strategy fell 3.25%, which is about 80% less downside risk than the overall market. Now there's a pretty cool thing in investing. In sports, there's all these statistics that people like to look at to determine how skillful a player is. In baseball, you have the batting average. In football, for quarterbacks, you have the quarterback rating. In basketball, you have the field goal percentage rating. And in investing, you have something called the Sharpe ratio, which is how much return you're getting relative to the risk that you're taking. So a high risk, high return portfolio can actually have the same Sharpe ratio as a low risk, low return portfolio, because the amount of risk and return that they're taking could be similarly proportional to each other. So if you can have something that has high returns and low risk, to me, I think that's pretty much the holy grail of investing. And for the S&P 500, the Sharpe ratio over the past 10 years was 0.66 according to Morningstar. So, which means for the past 10 years, the market has gone up about 10% a year, while its risk, its volatility measure of standard deviation, is about 15%. Now that Sharpe ratio of 0.66 for the market is just an average number. But remember, about 80% of investors fail to do as well as the S&P 500. So if you can get a Sharpe ratio better than 1.0, that's considered pretty good. Now, if you can get a Sharpe ratio better than 2.0, that's pretty darn amazing. Now, Can you guess what our Sharpe ratio was? Our Sharpe ratio was 3.51, and that compares to the market's Sharpe ratio of 0.50. So that means we were able to return 7 times more than the market for the same amount of risk that we've taken. And in football terms, these are kind of like Peyton Manning numbers. You know, they're pretty good. And it's doing everything I had hoped it could do. And I think it's even better than the hedge fund that I ran because it's more scalable and liquid, and it primarily trades just the S&P 500. Okay, so let's talk about the market. Right now, I think the market's a little bit stretched. I hate it. I hate it because the market's run up so much over the past week that the volatility index has fallen below 20. Now it's even below 19. And if you take a look at the relationship between the VIX index and the S&P 500, whenever this ratio has reached these levels, the market has tended to stall, and occasionally it has taken a dip from these levels. So I'm not really happy about trying to chase this market. I know the algorithm is still bullish on the market, but I don't want to go chase it up here. So I'm staying pretty cautious, and I have puts that I sold for the S&P 500 at 395 and 390. Plus I sold some VIX calls at the $65 strike price, and have a couple small bets by selling some puts on Costco at 460. And I did start to nibble on the banking index, KRE, and I have some short puts there at the $40 strike price. So overall, these are all really small bets, and if everything works out, I'll probably only make about $500 this week. And so, yeah, it's going to be below trend, but because of my caution towards the market, I think that's an appropriate bet size. If I take a look at my very crude valuation metric for where the market should be based on the yields on the 10-year bond, I think it's kind of it's pointing to about $398 to $407. So it's a little bit above that, which is giving me another reason to be cautious. So that's all I wanted to go over today. I hope you have a good trading week, and I will see you next week.